Hello, welcome back to the InsTech podcast. Zoya here. This week we're joined by a familiar name and face. Matthew speaks to Todd Rissel, CEO and co-founder of e2Value, a company that's been quietly powering much of the property insurance industry's replacement cost data infrastructure for over 2 decades. Todd and Matthew cover a wide-ranging conversation, from what it really means to be a pre-insurtech startup to how economic turbulence, tariffs, and weather volatility are impacting rebuild costs. They also discuss the realities of insurtech hype cycles, the role of AI in property risk scoring, and why barnominiums, yes, barnominiums, are a surprisingly meaningful part of the US property market. Now let's dive into the conversation.
So, hey, look, it's almost the middle of the year now, 2025. What's top of mind for you right just now as we're talking?
I guess the insurance market in a world of uncertainty, there was good news in 2024. I chuckle a little bit that Florida made money in 2024. So everybody says, oh my gosh, Florida made money. But I don't think it's made money ever, if you measure it more than 1 year. And then we throw in, and I know we're not talking about politics, and it's really not politics, it is the uncertainty of the world trade and the impact of tariffs on just day-to-day things, like I need to replace the fender of a Hyundai. And then that extrapolates into what do I need to do for a house and repairs, and what people ask us about all the time is replacement costs. And the good news is, I think so far it's had very little impact on replacement costs because nothing's really happened on that front. But I think it has had an impact, and you will see an impact on partial losses and auto losses, et cetera, over the next few months. But I mean, for us, it's another great year. We're very excited. We've had a busy spring. We've been, from London to California and every other place in between.
Well, crikey, there's quite a lot in there. I think you've defined a script now for the next half an hour. I'm just kind of working my way through those backwards. So, yeah, I was just telling someone actually today how he was asking after you how much energy you and Skip and your colleagues seem to have. I guess what's interesting in this the digital world is how important it still is to get out there and see people face to face. And I know you're a great advocate of getting out to conferences and seeing people. I mean, despite the sort of move towards technology and better ways of communicating, it's still, insurance is still very much a face-to-face business, isn't it?
I think so. I think it's one of the nice perks. We used to do office-to-office visits. We spent a lot of time traveling, seeing one office or one group or one company. And the conferences have become the gathering spot. But it's also a chance for a whole bunch of people to get together. And I think it's more efficient. Like, what were we, 5 years ago having a wine tasting virtually in a somewhat unknown world? But we really enjoy, at least I enjoy, and I think speak for everybody in the team, we enjoy the face-to-face part, much better than the video call.
Yeah, just on that wine tasting one, you were very noble when we did it back in COVID times, because for us, it was like, I think middle of the afternoon or early evening. For you, it was 11 o'clock in the morning. But it didn't stop you joining the enthusiasm for wine tasting. But it's interesting that point about visiting offices in the US. If you go and see someone in the US on a business visit, they sort of feel obliged to entertain you for a whole day because you've flown in. Whereas in London, you can just go and see somebody for a coffee and you're in and out in 45 minutes or so. So I do agree those conferences are incredibly valuable. In fact, often it's not so much about the sessions or the panels, although we would pride ourselves hopefully on running great panels. It's actually being able to have those conversations on the side as well with people. So I want to come back in a minute, talk about your point about the tariffs and the costs and what that might or might not have an impact on rebuild. But you also said right at the beginning, Florida is profitable. I assume what you're saying, it's actually profitable to underwrite or to insure in Florida. Is that what you meant by that?
Yeah, 2024, they made a profit in home insurance in Florida, which I think is the first time in a long, long time. I saw a great presentation earlier this year that it reminded everybody that Florida home has never made money. It's had a few profitable years here and there, but on overall, if you've been writing there for more than 5 years, you've never made money writing home insurance in Florida.
I know we've got many listeners to the podcast, and I know even some of the people in the insurance commissioners' offices in various states listen. So if you are listening in Florida, that doesn't mean that the models are no longer valid, and you should be limiting the technical rate for hurricane risk just because 1 year was profitable. I mean, the reason it's been so difficult to write it, I think, is because of the sort of the regulated rate filed versus the real true underlying risk.
Yeah, and I think that we need to measure how much premiums have increased. You and I met 8 or 9 or 10 years ago now, And I think overall insurance premiums are probably up 60% since you and I met, and still it's relatively unprofitable over that time. But really, at the end of the day, the industry isn't that profitable, and they've faced a lot of headwinds, tongue-in-cheek headwinds, hail, things like that, that have kept things moving. I guess interesting part for you and I is we've met over InsurTech. I think most of the InsurTech has come out over the past 10 years. And, one might argue that it really hasn't had much of an impact.
I mean, I think we met, the word insurtech hadn't even been coined, which is just kind of shows how fast time moves when you're as youthful as you and I. But also, of course, there's, in the US, you're actually now not as exposed to more perils, but I mean, there's more losses coming from flood, tornado, hail, collectively under severe convective storm, wildfire, of course. Yeah, partly actually not just to do with increasing incidence of the events, but actually when people are living in areas they weren't living in before. And I think also that InsurTech point is interesting in the sense that I was going to ask you a little bit about that. You've with e2Value, you've been going now, 25 or so years? Be right? Something like that?
25 years, yep.
Yeah. You sort of started, you were kind of arguably, you could say you were one of the insurtech type companies. I guess the difference was you didn't have massive funding and you made money and you're still going, which is all great. And it's sort of a bit of a reversion to the mean, isn't it, in how this funding has gone for these companies and looking at the survivors out there. And, I think it'd be great to get your sense as to what have you seen which companies have been successful through that period and which companies have not been successful, if you think about some of the themes that you would think about when you've been running your business.
Your partner in crime, Robin, is talking about where do you see things in 10 years, where are we going to be in 5 years, that type of process. But I think the impact of what is the latest trend or what is the latest craze and what gets funding, and today the initials are AI. I had a refreshing conversation at the conference we were with you earlier this year, where a person who's not on the board but does work with the board at a high level is always trying to de-sell what's been sold to the board. And I think that that's a struggle inside a lot of places. And I think if you looked at the InsurTech world, and so we are an inventive company. We're innovative, inventive people. So I'm not in any way against innovation or being innovative. But sometimes I think a lot is promised. I think you've mentioned this before. A lot of promise is promised in the presentation to the investors, and then they have to go deliver on it.
There's a great book, I think, which anyone should read, which is about what it's like starting a business in the old days. I mean, even before you started a business without funding, which is Shoe Dog by Phil Knight, who founded Nike. And he ran Nike for like 10 years or so as a side hustle, even when it was making, I think it was making close to certainly revenue, millions of dollars. And in those days, there's no such thing as VC firms or angel investors. You had to go to your bank and get a loan, and you just couldn't get a loan from the bank. And you realize how difficult it was. And to your point, it's great to have all that external funding coming in. I think part of the challenge has been actually, it's a bit of a game when you go out to get funding from an investor as a founder, which is you've got your hockey stick curve in your graph. You've got all the tech talk and you say like, hey, we need all this money. We're going to do some great things. The people who succeed, remember that was just a story to get the funding in. They've then got to be sensible about how they use the funds and not believe their own PR. The ones that get caught up actually end up believing their own PR and spending all the money and not delivering. So I think it's a bit of a two-way process. You can sort of fault the firms that put all that money into it, and then you can sort of say to the people that get the money, you need to be a bit more thoughtful about how you're going to spend it. But you've also got investors that want to get a return on their money. I guess what is interesting, if from our experience talking to people, I know you might have seen a bit of this, is it seems to be reverting much more back to the more traditional way of valuing a business, which is revenue and then a multiple of earnings on that revenue. And I think that's quite healthy for the industry, because I think it actually does call out where the reality is of the growth. And also to some extent, we're just looking a little bit into MGAs just now, and some of the crazy valuations for MGAs, 20 plus times on earnings for an MGA. People that actually didn't realize that MGAs were insurance businesses, so you've got to pay claims. It's looking at it all. It seems like they were looking at it all entirely on revenue. So I think at the time it feels a bit frustrating if you don't get the funding, but it does certainly put a discipline into the business about how how to run a business and make money and grow.
There's a gentleman named Brian Sullivan that runs the Property Insurance Report. And he writes about property insurance, and he runs a couple of seminars each year. And this is his quote, so I want to make sure I give it to him and I say it right, is, banking is for kindergartners and insurance is hard, right? Insurance is really hard. And there was a video I saw the other day about, when you're writing insurance, you don't know the input costs, the output costs, you don't know anything, you can't price until 5 years after you did it. So it's a challenging business, and I think that's the exciting part of it. And you mentioned the severe convective storms, hail, lightning, tornadoes, and things and I think it goes to your legacy. And I met most of the RMS mafia at your event there. That there's risk modeling, and risk modeling was a bold step, was a great step. But now we're getting to things that are harder to model, like severe convective storms and those processes where people might have fallen in love with a model and then realize, oops, it's not in the model. It's hard to model where the next, hailstorm is going to be. I can tell you it's between the Atlantic and Pacific Oceans. That much I know it's going to happen. But the world's changing. And I think it's, if the extrapolation of this thing works in this spot, so it should work in that other spot, where realistically what works and what was drilled into my head when I was just starting in insurance and it stuck with me is that, you measure your profits and losses over 5 years minimum, and small loss are the things that are going to eat up all your premiums and cause all your losses. The big losses get the headlines, the big losses are the problem, but small losses keep you in business or not.
Yeah, it's like managing your household budget. You have all those small little extra costs and suddenly you don't really have much money in your account. And then Brian Sullivan, thanks for mentioning him, because of course you introduced me to him. I spoke at his conference, and I think that banking is for kindergarten, insurance is for grown-ups is very true. I mean, even to a certain extent about how insurance companies measure risks. I've always felt that insurers are much more sophisticated about how they think about long tail risk, whereas bankers, I'm going to oversimplify it and lose some of my banker friends, but they sort of look at a 100-year probability, 1% probability or something, and sort of that's as bad as it gets, or if it hasn't happened, it's not going to happen. And that's what we've seen has caught people out quite a lot in the last few years. Whereas insurers know bad stuff does happen and you just manage for it, and you just don't want to be in a position where you have a big loss that is going to take your business out. Let's go back to this point about tariffs, though, and rebuild costs. So I guess it's still early days, partly because they keep changing. But I think so. What you said, that hasn't come through yet. But as you think about valuation and your valuation models, that's presumably something you have to take into account if the cost of goods is going to go up quite significantly.
Our valuation model and our process that we put together has always been and will be is looking forward, because the replacement cost is as of today. And so what happened 5 years ago, or adding a percentage to what happened 10 years ago is we don't think is helpful or in any way productive. But we're looking at what's going to happen 6 months from now and a year from now. And we keep it to those two windows. And it's really replacement cost is driven, and we've written about economic conditions. Economics drive it. So when COVID happened, a lot of the world didn't know what happened. We didn't know what was going to happen. But the price of rebuilding went up 50%, since then. And that's a 4-year span. So in 3 years, it went up 40%. That was a sort of a big event. And if you're looking back and trying to catch up, you just can't. We don't think you can. Whereas the same with tariffs. I mean, it's an economic condition. And so the tariff itself may end up being an impact of 15 or 20%, right, on a particular item. But in the scheme of things, the economy is doing more poorly than it was before. So the ability for a contractor to pass that cost along maybe is not there. I think the other part, and it's all tied together, is, interest rates and buying homes and building homes. And, at least in the States, we're way behind, and if you quotes, way behind building homes for the population part of it. And building permits, I think, are down this spring as well, because that is a precursor of economic conditions. And I think that what we're measuring is what prices can be passed on to the consumer, what prices can a builder put out there. I think maybe 6-7 years ago, they financed a lot of apartment buildings and apartment and condo buildings. And they're not financing as many today, because if you looked at the interest rates 5 years ago versus interest rates now, with sort of a flattening in price, they're not really financing the apartments and the condos and the bigger projects. So that affects commercial. At the same time, there is this AI, which requires a lot of electricity infrastructure and things. And so they're building on a commercial grand scale. So there's always a squish to where things are going. And so if someone's building an electric power grid or building an electric plant or a chip making place in Iowa, how can that impact what's going on in New York? But it does.
We've been talking about AI a few times, either you personally or in the business. I mean, you're quite good at tapping into genuine trends. What would be your example of whether it's generative AI or old-fashioned AI or agentic AI, that you've been using personally or in the business?
Technically, what we do in our pricing is AI, right? We're taking gobs of data, we're looking at an algorithm, sorts through the data in the process and says, this is the answer, right? So that is AI. I just announced, so I can announce it today. So we have partnered with WTW to build the structure insurance score. So we score homes for the propensity to various types of losses. And so WTW and e2Value built that together. And as of yesterday, it is now, e2Values. We still run it through the WTW radar system. And so, but e2Value has that. That's another example of AI that was pulled that together, because I think at the end, it was something like 900 million individual points of data that you got to sort through to come up with stuff. And you need AI to be able to do that. There was a book, AI Snake Oil, and it puts the example of really everything comes down to the data that you're training the AI on, right? The data has to be good.
Okay. Now, another thing I wanted to check in on, which I heard you on the other great podcast, the reinsurance podcast that Jared Lee and Ben Rose do. You and Skip were talking about barnominiums, and I thought that was just tremendous. So you better explain for those that don't know what a barnominium is, and I'd love to know how barnominiums are getting on in the world today.
Well, hey, barnominiums are a great thing. So essentially, it helps to be a farmer. It helps to actually be making money in the farming business. And so you would like a barnominium. So instead of building a tractor shed and a hay barn and then a house, you build one big structure. Probably not hay, but you build it for all the other tractors and the implements and those things. And at one end, you build your house. And so your house is inside the barn, so you save on the cost of building an entire house. There's a pretty big part of the market, I would think, maybe 12 or 14 years ago, somebody called up and said, I've got a barnominium. Can you help us price it? And we said, sure. We got a tool right here to put those things together.
What else, Todd? What's kind of picking, what sort of engaging your attention just now?
Oh, there's a lot going on things. Every morning I read the news, the insurance news. Interesting where things are going. I think that, when you think of the U.S., it's a pretty big area, and it has some pretty big challenges going on. I saw an interesting article in Louisiana. The storms rarely hit Louisiana, and there's really no insurance crisis in Louisiana. So they decided they're going to pass a bill. It looks like it's going to be passed where an owner of a property can just decide on the number that they want to insure their building for, and the carrier has to insure it for that number. So it'll be interesting to see where that goes. You can just pick a number from assessed value down, and that's all I'm going to insure it for. And I say, well, good luck. We'll see how that works out. So it's just interesting about the pressure, though, in certain markets like Louisiana, Florida, California, where the pressure of just trying to buy and sell a house will put a lot of pressure on a legislature to make a law or make some sort of regulatory change that eases the market, that usually wrecks the market.
The Louisiana one. So if you've decided to lowball the price of your property, because presumably you want to lowball the price of the insurance, what happens when you have a loss? Do they say you only assessed it at half the rebuild price, therefore you're only going to get half the money towards your rebuild, or is that still to be decided?
I assume so. I don't know that they read the insurance contract. And so I don't know if you have a named amount, you can hold them to an 80%, right? An 80% clause, like in most policies. And so it's sort of the named process. So I think for the owner, I understand it, if you only have $100,000 invested in a property, I don't know why you'd want to insure it for $500,000. There's a place that's on the way to where my daughter goes to college, way upstate New York, called Bangor, New York. And a regular house ready to move in is like $125,000. The replacement cost of that house is probably $1.2 million because it's a solid brick house built in the 1850s. But you bought it for $150,000. I don't need a $1.2 million house back. And I understand the position they're in. The issue is when you have a water loss, the water loss is measured against 1.2 million, not against the 150,000. So the carrier's issue is collecting enough premium on those small losses. Way back when I worked at an insurance company, that was still an issue. The houses that are worth millions to rebuild, but only a few $100,000 to buy and sell, puts the carrier in, I guess that's called a moral hazard position. It puts the homeowner in a moral hazard position. And how do you fix it? And the issue is collecting enough premium on those little things that are going to happen and that amount. So I think you can adjust the rates for that. And I think probably the worst way to set the rate on a structure is based on the value, because it doesn't tell you about the exposures or how it's going to react to the exposures.
But it just reminded me that I've got a business idea for you, because it's just between the two of us, which is all this talk about generative AI and assessing insurers. And what I feel we certainly need here in the UK, and I bet it'd be useful in the US, is a way of assessing your insurance contract. And it comes back for your property and says, you are insured for this and you're not insured for that. And therefore either find a new carrier or don't insure it or do something else, because I don't need to bore everybody with this. I've bored enough people already. But we had an insurance claim at home with something that we thought should have been covered by the standard policy, and it wasn't, and it was the price of a small car to get it repaired. And I was just really angry. So actually actively now, what we're looking for is something where you can put your insurance policy in and go, right, okay, what am I not covered for on this? Would you back that as a new idea for some seed funding to go and do that?
I think that's a great idea for funding. I think I look at that and I think that people look at insurance, we were talking about how complicated it is if you knew what was going to happen, you would not need an insurance policy, right? You're like, 3 years I'm going to have a fire, so in 3 years I need a policy. But this year I don't need anything, so I think there's probably a surprising lack of imagination of things that can go south. Now, in your unfortunate case, they use self-script auto policies in the States. Like, you can pick and choose your coverage amounts. And I think ultimately the person that chooses a low coverage amount should probably have a high coverage amount. And the person choosing the high coverage amount might not need the high coverage amount. And so, it's like really understanding the risk.
And I think to your point, I'm sort of okay having a policy that says that's not covered. I just want to know in the policy. And so actually the second part of this, my business idea that you may or may not support, is you actually look at the claims, what's the claims settlement, what's the claims handling of the company. So what are you looking forward to the next 12 months? Is it going to be upbeat and positive? And we can check in on when we talk again, or at least record something again in 12 months.
True. Well, I think we're very excited about rolling out Structured Insurance Score under the e2Value banner. We're very excited about some products we're going to be rolling out in the lead gen space. I know it doesn't affect insurance directly, but lead generation is a big part of insurance. Insurance companies pay for most of the lead generation business that goes on out there. I'm just interested to see where things go from a capacity standpoint. When we were talking to folks last December in London, there was sort of rumblings about, the results have been good. I'm just interested where it all works out. They called it a hard market in 2018, and it's kind of softening a little bit, but then things happen. Realistically, where the GDPs of various countries go and sort of the economic impact over the next 6 months. I think in 6 months we'll have a better idea of where things are versus now.
In 6 months we'll have a better idea where things are in 6 months, but we'll still have no idea where they're going to be 6 months beyond that. So yeah, we will know when we've arrived, but we kind of still won't know what's ahead of us, which is what makes life interesting. And I think if we can embrace that and be enthusiastic and manage the risk, then that's what gets us up in the morning and keeps us smiling.
Absolutely. So, but now what's going on? Like, what can I look forward to maybe next year with InsTech?
I think the themes we're seeing are, we talked a bit about catastrophes, climate, property, your world. That's a great community. I mean, those people have been working in that space using analytics data for like 30, 40 years. And to me, that encapsulates all that's great about insurance or analytics or academia, because they all come together, sharing of information, value for people for their intellect, willingness to debate, discuss, and ultimately people do all benefit. If you do a better job of assessing risk, insurance comes in, insurance influences people to change how they're managing their properties and looking after them. Ultimately, people do benefit from it. And I'm just really enthusiastic about how that's all happening. We're getting a lot more companies coming in, as you said, into space. It's still very difficult to model. You can't just get a PhD and a supercomputer and you build your next catastrophe model, but it's all moving in the right direction. So, yeah, really excited about that. And then, probably some other news out there we can talk about next time we're together. It sounds like you might have some news. So hopefully that'll kind of be good news all around as well. But lots more going on in the next 6 to 12 months is our side too.
You did a great exponential risk. I love that conference. Is there another exponential risk next year?
That's been a leading question, Todd. You've been good enough to be the kind of one of the early supporters. Yes. So we're doing that again. So this year we had capacity for 340 people and 339 turned up. So it was quite cozy. So we've got a bigger venue this year, and we've got more breakout space. And people like the kind of variety in there. It wasn't all talking about technology. It wasn't all talking about insurance. Quite a lot around people and how do you manage your boss and how do you share information and how do you manage stress. And some really great speakers. So yeah, very much looking forward to that again next year. A bit more breathing space now. We've got a slightly bigger capacity. And again, we're going to have to manage that balance between the insurers in the room who are buying the technology and the people who are there offering the technology and selling it. But we had 60% insurers in the room this year, and it's definitely the kind of way we want to get next year. So thank you, Todd, for your support for that and reminding me about that as well. But very much looking forward to that. March the 10th and 11th in London. Anybody that wants to mark it in their diary. Excellent. Well, Todd, that was great to catch up. You've always got some refreshing insights on the world. Tell it as it is. And thank you again for your support. And when are you next back over in the UK? Have you got some plans for anybody listening that wants to see you face to face?
I don't think it'll be till October, but I think in the first couple of weeks of October for sure. And then we always like to do our holiday visit now as well, because whether you celebrate Christmas or not, just London just blows me away for the holiday spirit and the holiday time. So we love to come back over there.
And London and Wrexham as well. I mean, Wrexham will be missing you if you're not back up there again. You've been a regular back up to Wrexham, haven't you, to see the football club?
Well, I do get a note from them because ever since we've been fans, they've been promoted several times. They do say continue to be supporters. Where I think they're Championship League or this year or whatever. So we do get to Wrexham. I got a nice little gift from them early this year, and I think at least I'm going to lengthen the podcast or whatever. But so I have two Wrexham knit caps, right? Because it's rather chilly sometimes up in Wrexham. And so they mailed me another one. And, when you wear the Wrexham knit hat in London, people recognize, the Red Dragons and like, why are you wearing that team's hat? What can you possibly know about Wrexham's team hat? And I said, so I was wearing it at a baseball game in Pittsburgh a week or so ago because it was so cold. And Pittsburgh is, gold and black. The other team was gold and blue, and I was wearing a red jacket and a red Wrexham hat. And the guy's like, you don't fit in here with the red stuff. He goes, what's that hat? I said, that's Wrexham. I said, so I told him the story, and I feel like I was back in London telling people about, the series and what's going on. But I do note, and I want you to know, Skip couldn't be here today, but he's also included in the fan club that since we've been on board, and we hopped on a little late, I guess, they've been doing really well.
They have. Well, I'm sure they're blessed with your support. And my tip to you, which I think you took up, anybody else wanted to go to Wrexham, but actually spend the night in Chester, which is only about 15 miles away. It's Wrexham's okay, but Chester's kind of pretty where you want to spend your time. But Todd, on that happy note, I'll let you get back to your day. Great as always to catch up, and to see each other in October, and when we find an excuse to get a few people together, and you can show off your Wrexham woolly hat, which you probably will need in October.
Oh yeah, I'm definitely going to be wearing it. So thank you, Matthew. I appreciate it. Good to see you.
Well, if you've made it this far, then I'm pretty sure you found that as interesting as I did. The InsTech podcast comes out every Sunday morning, where we spotlight the latest news, leading voices, and freshest updates across insurance that you need to know about. If you would like to take part in these conversations, head to www.instech.co to find out how you can join our network and be a part of the insurance intelligence for the curious.